Welcome back. This is Neil Dailey with McGraw Commercial Properties along with Julie Buxton. We're talking about retail here entering into the last quarter of the year. So we're wrapping up third quarter. We've seen what happened so far this summer, coming through COVID-19, and how are things responding amid all of the uncertainties. So let's start from a broad view. So from a national perspective, Julie, what are some headlines or what are some topics or main themes that you're seeing on the broad scale?
So broad brush, I think there are certain segments within retail that are doing well. Your standalone grocery stores or your centers that are anchored with grocery stores, your dollar stores, Dollar General, Dollar Tree, Family Dollar, those are doing well. Single tenant drugstores are also doing well. Restaurants, be it local or national, that have been able to use their patio space and parking lots and convert that into outdoor dining, those are still doing well.
Right.
They're not printing
money.
Right. They're eking through the survival lane, if you will, while others, and I know we can all think of some at the top of our heads, be it regional or national restaurants, and of course national retailers, both in your middle America price point as well as your luxury goods. A lot of those haven't fared very well for different reasons. So it's interesting.
So grocery stores really kind of keeping everybody afloat in anchored centers because it's still bringing traffic into the center. On the Dollar Tree side, those are still operating somewhat pandemic proof. So that also goes into the net lease environment as well. So those things are still available. Have you seen any change in cap rates at all?
Yes and no. What's interesting is from a time, I'm not sure if we want to dive into what we're seeing in the Tulsa market specifically or keep it on the national level, but what's interesting is when you look at some of the data in the Tulsa market compared to the national level, our cap rates are actually higher on the retail side than the national average. The last piece of data that I saw, the average Tulsa market cap rate for retail was 8.5% compared to the national, which is at 7.2.
Like everything, you can break that down into very specific numbers, and that's a broad number. Those with grocery stores, those with dollar stores, the Dollar Trees, those are still operating, and therefore investors in 1031 situations are looking for what can I buy, and so those would be, I guess, quote unquote, still essential retailers. And so I have to think that the 1031 market is focusing on those, and it would be very hard to get a hold of a Walgreens, a CVS, a Dollar Tree, almost regardless of location at this point. So if you are a dollar store developer and you have one in a small town USA, which normally the exit strategy or the exit real estate isn't all that great, you might have some luck getting that sold into the investor market now. So it's good news for the developers there. So you mentioned the Tulsa level. So if we drill down from national, let's get into Tulsa. How are retailers here performing any different than the national scale?
The data that I'm looking at or have seen and different sources overall, I think is on a not necessarily a positive trend, but it's certainly maintaining, it's holding its own compared to the national level. There are submarkets within Tulsa that are doing better than other submarkets. The South and the East, Southeast Tulsa, Southwest Tulsa, South Central is doing well. Midtown in terms of absorption and vacancy rates, it's stumbled a little, but south of Tulsa, Southeast market or submarkets are doing well in terms of positive absorption, as well as even a slight uptick in lease rates.
And those are areas, if you know Tulsa, those are areas that have grown over the last 10 to 15 years, where it's a growth ring, where it's the new big box retailer, and then another growth ring of another big box retailer, or a retail strip environment. Whereas the Midtown, even North Tulsa, are more dense residential, and the commercial or the retail that we would have there would be infill. Is that fair to say?
That's spot on, yes.
Okay.
And the other thing, you mentioned the growth. When you look at the markets outside of Tulsa, your Rogers County, your Wagner County, your Creek County, as things go east and west and south towards Bixby, towards Glenpool, towards, even East Broken Arrow, Claremore, Coweta, those markets I'm not a residential expert, but there's a huge housing growth in those markets as well. People wanting to leave higher densely populated areas and have more land and have more space and have more privacy. And so, to your point, as we're seeing these rings of growth in these different suburbs, a lot of, the retail side is benefiting, but it's also the housing market's headed that way as well.
Being connected to the McGraw realtor side, you hear realtors in the office talking about the housing boom, and that there's a shortage of inventory, and everything that comes onto the market, whether it's even, photographed and quote unquote listed or not, it's still selling. I mean, my wife was talking about how all these homes that she finds online on the McGraw app that are selling before they are even showing up. So they just show up as pinned. So that's an interesting statistic, and that appears to be the same in a lot of other markets, with the exception of maybe in New York City or even in LA, where I think there's an exodus in that regard. Okay, so from a Tulsa regional standpoint, we're seeing those areas experiencing no real growth, but still maintaining in the power centers. So the Class A real estate, or the best real estate, is still functioning as long as there are essential retailers involved there. Any specific tenants that you're featuring, or anybody out there that is still expanding? As an investor, you always want to kind of look for those that are still growing and evolving. Anybody you can put your finger on that, kind of a stock tip, if you will?
Well, what's interesting is, again, in the Tulsa market, we've seen some of the financial institutions shed real estate, be it through subleasing or selling some of their, putting on the market for sale some of their freestanding assets. But I know that there are also several that have taken a hard look at building. We talked about the South Tulsa market. There's different land parcels out there that are available, and that trade area fills a hole for several of these regional financial institutions. So I've seen some financial institutions take a look at some land. I've seen through pent up demand earlier in the year, once COVID hit, this is something that I'm seeing now, is sports offerings, private trainers, gyms. Once everything was locked down with COVID, these users and these occupiers were kind of, sitting on their hands. So I've seen an increase in demand for those kinds of tenants, be it they're the owners trying to find space or the landlord wanting some type of that user in the space. Nail salons, I've actually worked with several nail salons on trying to find retail space for them. And medical marijuana, the dispensary retail side is still very hot. There's a lot more demand for that type of, as a user wanting that space than landlords are willing to lease. So I think those are the high level ones that I'm seeing.
Strangely, this is a great opportunity for the medical marijuana industry. For reference, Oklahoma became open to medicinal marijuana within the last 2 years. And so now we have a pandemic that has gone through. People are still claiming, or they were an essential retailer, they were allowed to stay open. And now you're seeing more influx as the numbers of card carrying medicinal marijuana users has gone up tremendously. It was a huge spike in numbers that rivaled that of Colorado and California and Washington. Venture capital money or outside funds or interest are coming in now and establishing themselves in the area. So it's no longer, the one-off person that gets their license and comes in and establishes a dispensary. It is a vertically integrated organization that comes in, and they're doing processing, they're doing growing, they're doing dispensing. They're even buying people out. We've been in the cycle long enough where maybe somebody's not as great as they thought they were at managing a business or running a business. And so now they have a dispensary that they've started, staffing problems and turnover and closings, and they're falling out. So economically, the more well-funded, more seasoned operators are coming in, taking over some of those locations. So that's an evolution of things that are happening in the Tulsa area. This is a great snippet of information of what's going on kind of nationally as well as Tulsa. Anything else you want to add?
I just think, again, the Tulsa market has a lot of nuances to it that I don't think you're going to see in other, not even major markets, but even similar markets. the landlords that we have, I think, are very creative and very resourceful regarding how they are rethinking their space, not just traditional retail, but converting it to unique office space. There's a lot of investment money in the Tulsa market that's sat out for a while, and that now is coming back into looking at different plays there. So from a retail perspective, I think the Tulsa market has a lot of things going for it. Whether you're an owner, whether you're a prospective tenant, whether you're local, whether you're national. I think it's something to look at and consider. E-commerce, we know, has been has had a huge disruption because of COVID, or it's been exacerbated because of COVID. And I think there's an opportunity for some of those newer e-commerce shops like Warby Parker and StockX to do short-term leases for like showroom type space or try before you buy space. I think there's an opportunity for landlords to offer pop-up shops to soft goods, not just going into the holiday season, but also something to think about, long-term carried into the new year. That gets revenue in the door for them if they've got a vacant space. So I think there's a lot of different things going on in the Tulsa market, a lot of different possibilities that can be done depending on the tenant and the landlord. And I think it's a place where people should look.
You bring up a good point about the holiday season. So those are new things that people have to think about now. Ordering from the consumer, ordering things online versus the retailer thinking about what sort of inventory or stock do we need to keep on the shelves for the upcoming holiday season, and ordering things online now. What a tough time to be a retailer to really try to and judge this merry-go-round to see what happens. So those are good points. I think the local side is going to see a lot of change. You mentioned the pop-up shops. We've seen stories about Simon Malls working with either Amazon or turning their mall into a retail distribution center, taking up a lot of the vacant space, which you think about it, a JCPenney's or a Sears or something like that has 30, 40, 50,000 square feet, multiple stories, and they're right in the middle of town. So it makes it a nice idea from a centrally located distribution hub to have everything there. Plus, they could probably create a customer experience as well. I don't know if they're even talking about that, but people could go to the mall and still have opportunity to buy things there on the shelf. Thank you very much for your time on this. Again, Julie Buxton, working on the retail team here at McGraw Commercial Properties. I'm Neil Dailey. Thanks for tuning in, and we'll talk to you soon. Again.
Thank you.